So basically, this video is about Indian Express is wrong about bond yields, and what it says is that in short, a rise in bond yields means interest rates in monetary system have fallen. This is false. This is incorrect. This is actually misreporting and then put and explained by Financial Express. The misreporting is here. Varkhari said a rise in bond yield means interest rate in the monetary system have fallen. What I do believe is that what he meant to say was bond prices, because bond prices and interest rate are inversely proportional, as can be seen in the Security Exchange Commission of United States and Investopedia site. All of these sites categorically say that whenever the interest rates are falling, the bond yield must fall, as you can see, or vice versa, and inverse is also true, which would mean that, for example, take this term. For example, this table is market rates and yield to maturity. Yield to maturity. What is bond yield exactly? Bond yield is nothing but fixed interest, that is also known as coupon rate, divided by bond price, the price of the bond. So what happens is, at a particular time, there is some kind of a liquidity in the system. Now the investors have to make a decision whether they want to keep the money or they want to invest. So if there is large liquidity in the system, then the people will try to invest as much as possible to get high returns, which would mean that there is demand for investing options, one of which is bonds. Bonds are generally of companies and/or government agencies, which would mean that demand increase is increase of bond price, and bond price is inversely proportional to bond yield. And now, as you can see, that if there is more demand, that would mean that there has been more liquidity, and liquidity is inversely proportional to interest rate. So liquidity is inversely proportional to interest rate, and it is directly proportional to bond price. It is hence is inversely proportional to bond yield, which would mean that bond yield and interest rates are directly proportional. Every other thing is kept constant. The concepts in economics, when we are talking about if we are talking about macroeconomics especially, then these concepts are thought of in a bubble in which every other thing is kept constant, and then we see in that particular model what will happen. So they propose a seesaw model for interest rate and bond prices. It is very, as I cleared it up earlier, when the interest rate was a proxy for the liquidity in the system. What will happen if I have some money and if I have some investing opportunity? Then what, as an investor, as my job is to get more money or get returns of the money that I hold. So I will invest in multiple options. For example, debt mutual fund actually invests in bond, and hence for debt mutual funds and their managers, bond yield is a very important indicator. So the interest rates are inversely proportional, seesaw relationship between bond prices and interest rates. So if interest rates rise, that would mean the liquidity is reduced. If liquidity is reduced, demand is reduced, which would mean that bond price will fall. So interest rate increases, bond price falls. So here is a table that they made. So for example, at a time you purchased a bond of $1,000. It is a bond which matures in 10 years, which would, and the market interest rate is at 3%, and the face value is 10,000, and the coupon rate is 3%, which would mean that at the end of the 10 years, the total amount of interest that you generated, the return that you generated, will be 300 if you held this bond till maturity. So the bond yield till maturity is 300 divided by 1,000, which is divided by 1,000 divided by 10, that is 3% per year. All right, yield to maturity is 3% per year. All right. So for example, so this is, so now any loan given or a bond given. So if a bank gives a loan at 3%, or if it gives that particular money to a company through purchasing of a bond, they will be equal. Now, so for example, the market interest rate fall to 2%. What would happen is that now 1 year has passed. Now you will only get $270 in the upcoming 9 years from this bond, because the coupon rates are fixed. That means the interest that you are generating per year is fixed. So now what will you need to do to actually make it so that this particular bond is of equivalent value as per the market supply and demand? So what you will do is, now the face value is 1000. When the face value is 1000, you will get at the end of this bond, you will get 1000 and 270. So now you will get 1270. Now 1270, if interest rates are lower, the people are going to buy because there is more liquidity. The demand will increase. The demand will increase. The 3% interest return rate is much more lucrative, right? 3% is much more lucrative as compared to 2%. Now, as the interest rate have fallen, the banks will be more willing to give the banks will be inclined to give the money to the bonds as compared to giving loans on the interest rate of 2%. So now, when will the equilibrium be achieved? The equilibrium will be achieved when the banks find that the bonds and the giving of loans are equal with respect to their returns. So that when would that happen? That would happen when the yield is of 2%. That is the equality. That is where the equality is coming from. That is where everything is arising, because the option have to be equal at equilibrium. The option of giving interest or obtaining a yield are going to those things are equal. These two things are equal and they cannot go opposite. There is no trade-off between these two things. These are comparable things. These are the same, because these are two options with respect to the investors. So they cannot move in different directions, and that is what is shown here. So the price will adjust itself. So now you will be at the end of the maturity, you will be getting 1270. So now the 1270 would should generate 1.18%. That is 9 into 2 is 18. So the 1.18 into 1082 should be your 1270. I will show you this. Into 1.18 is $1276, right? So you kind of get it what they are trying to. So you get it what they are trying to say, right? So this is what it should be. The yield to maturity at the end. If you do not understand anything, what you have to do is that the people in the Security Exchange Commission that have put it out for everybody to see, the United States government body. So this is an official document, and this is just a report by a journalist, George Matthew. This is just a report by a single person, and that is based on a report by another single person, and there has been lesser amount of research, whereas this is completely official and hence much more reliable. So what they have, so in this sense, if you do not understand anything, all you have to see is when the market interest rate decreased, yield to maturity decreased. If the market rate interest rate increased, yield to maturity increased. Interest rate and bond yield are going in the same direction. Interest rate and bond yield are going in the same direction. It has to go in the same direction. This explained is wrong. Hence, it is wrong. Their explanation is also in reverse of what this in short they have said. They have said a rising interest rate causes bond prices fall and bond yields to rise. That is, rising interest rate means bond yields will rise. So in short, a rise in bond yields means interest rates will have fallen. That cannot be true because there is a relationship. So that is what I wanted to say. Indian Express is wrong. Please do not commit this mistake in the exam just because some newspaper incorrectly reported it. All right.